Welcome to Bertie. My name is Bert and I will be your online learning buddy. For today's tutorial, I will discuss to you the basics of the adjusting journal entries. So sit back and relax and enjoy learning accounting. Okay? Alright, good day to all of you. Our topic for today is adjusting journal entries. So what is adjusting entries? An adjusting journal entry is an entry in a company's general ledger that occurs at the end of an accounting period to record any unrecognized income or expenses for the period. The basics of adjusting entries that you must know. First one is adjusting entries are entries made at the end of accounting period to ensure that revenue recognition and matching principles are followed. Okay. Adjusting entries are required every time financial statements are prepared and are dated as of the balance sheet date. Another one is that adjusting entries are needed because some events are not journalized daily because it is inexpedient to do so. Examples are the consumption of supplies and the earning of wages by employees. Next one is some costs are not journalized during the accounting period because they expire with the passage of time rather than through recurring daily transactions. Examples are equipment deterioration and rent and insurance expiring. Another thing is that some items may be unrecorded. An example of a utility bill that will not be received or paid until the next accounting period. Now, there are types of adjusting entries. We have the so-called prepayments or deferrals. Prepayments are, it could be prepaid expenses, and these expenses paid in cash and recorded as assets. And we also have the unearned revenues, cash received and recorded as liabilities. Then we also have the so-called accruals. If we say accruals, we have accrued revenues and accrued expenses. Accrued revenues earned but not yet received in cash or recorded. On the other hand, the accrued expenses, expenses incurred but not yet paid in cash or recorded. Okay, now I'm gonna share to you 4 quick notes to master in doing adjusting entry. The first one that you must know is the method to be used. In journalizing adjustable events, there are 2 methods being initially used. We have the income statement method and we also have the balance sheet method. If we say income statement method, these accounts that requires adjustment soon are initially recorded as income or expenses. And on the other hand, if the balance sheet method is used, these accounts that requires adjustment later on are initially recorded as assets or liabilities. Okay, another thing that you must know is the period covered or adjustment date. If we say adjustment date, it is usually in the end of the accounting period. And if we also say period covered, it is the coverage of the adjustment. Say, for example, there is a prepayment of rent, then you need to know how many months covered for the adjustment. Okay? Next is the accounts to be adjusted. It is good that you already know the method to be used because this will indicate what accounts to be adjusted during the adjustment date. Okay? And you always bear in mind that in doing adjusting entries, it always affects the balance sheet accounts and the income statement accounts. Now, the number 4 is the amount of adjustment. This is one of the most crucial part of the adjusting entry. You must know how much is the amount of adjustment. Okay? Now, for you to better understand adjusting journal entries, let us follow this illustration or example. B company initially records all prepaid expenses as expenses and all unearned revenues as revenues. Given the following information, prepare the necessary adjusting entries at year-end December 31, 2020. So in this particular example, we can surely know what method is being used. Okay, it is the income statement because they record prepaid expenses as expense and they also record unearned revenues as revenues. So it's all income statement accounts. Okay, now let's move to the next transaction, supplies. On January 3, 2020, 3,500 of supplies were purchased. A count revealed 900 worth of supplies is still on hand at December 31, 2020. Okay, in this particular transaction, you already know that there is still a balance of your supply amounting to 900. Okay? For you to better understand this, it is good to know what was the initial entry made. Okay? Since we are using the income statement method, this was first recorded as supplies expense debit 3,500 and cash 3,500. Okay. And the same is being posted as follows: supplies expense with a balance of 3,500. Now, at year end, we are required to prepare the adjusting entry. And the adjusting entry is as follows. So, supplies 900 and supplies expense 900. Okay, let us explain this one. Since there is still a 900 worth of supplies on hand, therefore we need to establish ending balance of the supply at year end amounting to 900. Okay. Now, supplies expense, we need to deduct 900 from the supplies expense initially recorded as 3,500 because in fact it is not yet used up. There is still a 900 balance on hand. Okay? So now, if we are going to look on the ledger account of each account, we can see that their balances during 12/31 is, for the supplies expense, we have 2,600. And that is from initially recorded 3,500, remove the effect of the adjusting entry of 900, therefore the balance is 2,600. And on the other hand, the supplies, there is a established ending balance of 900. So that is the effect of your adjusting entries. Okay, so I hope you understood this part. Now let's move to another example, prepayments. On January 4, 2020, a 21,000 payment was made to an insurance agency for 3 years of insurance. Okay, take note the 21,000 is good for 3 years. So if you are going to get the insurance expense for 1 year, it's only 7,000. Okay, so if you are going to make adjustment for the year 2020, the adjustment would be debit to prepaid insurance 14,000 and credit to insurance expense 14,000. So again, this was initially recorded as insurance expense amounting to 21,000. But the real expense for 2020 is only 7,000. Therefore, there is still a remaining balance of 14,000 as prepaid insurance. So in your ledger later on, you will see that the insurance expense is only 7,000 and for the prepaid insurance, there is still remaining balance of 14,000. Okay, all right. Next is example of unearned revenue. On June 30, 2020, received 9 months rent in advance from a tenant, 81,000. Take note again that this is good for 9 months. Therefore, if you are going to get the monthly rent, it's only 9,000. Okay, 9,000. Now, if we will make the adjustment from June 30 to December 31, there is only 6 months. That is from July 1, July, August, September, October, November, and December. Therefore, the revenue to be recorded in this particular transaction is 9,000 times 6 months. So it should appear later on in the balance of your revenue, 54,000. So how do we arrive now at 54,000 rent earned? Okay, so by doing this adjusting entry, we can arrive later on at 54,000 rent revenue. Okay, so here is the adjustment. Rent income, 27,000. Okay, and unearned rent, 27,000. So since it was initially recorded, this 81,000, entire amount of 81,000 as rent income, and in fact, it's only 6 months. The earned part of this 81,000 is only 6 months. Therefore, we need to minus or deduct 27,000 in your rent income. So we debited 27,000 and we considered it as still unearned rent income. So if we are going to look under ledger, you can see these balances. So unearned rent income, 27,000, and the rent income is only 54,000. How about if we will do the balance sheet approach or balance sheet method? So the same, let us just read again the problem. So B company initially records all prepaid expenses as assets and all unearned revenues as liability. Now you notice that the asset accounts are initially used in this particular approach. So method use, of course, the balance sheet. Now we go back in our previous example, the supplies. On January 3, again, so 3.5, and there is still a 900 worth of supplies on hand. So again, if we are going to see the initial journal entry, it was recorded this way. Supplies, 3,500, and cash, 3,500. So you notice now the difference of the income statement approach and the balance sheet approach. So in this, you can see supply is being debited. Okay? Now, for the adjusting entry, you can see the debit would be supplies expense amounting to 2.6 and supplies credit amounting to 2.6. So this adjusting entry will have an effect to the ledger of the following accounts as follows. So you can see supplies expense is 2.6 and the supplies balance at the end of the reporting date is 900. So the balances being reported on the ledger in each or in either approach, the income statement approach or the balance sheet approach, is the same. Okay? Only the initial entry and the adjusting entry vary. Okay, take note of that. The next is how about prepayments? So the same, the prepayments of insurance, 21,000. So the initial entry is, of course, to debit prepaid insurance and cash, 21,000. Now, if we go to the adjustment of this particular account, you will see prepaid insurance expense as debit, 7,000, and prepaid insurance as credit, 7,000. This will lead again to the balances of each account at the reporting date. You can see the insurance expense is 7,000, and for the prepaid insurance, okay, balance sheet approach and income statement approach, they have the same ending balances upon adjustment. Okay, next is the unearned income. Okay, so now we initially record this as cash 81,000 and unearned rent income. So initially it is recorded as liability. Okay, So for the adjustment, therefore, we need to deduct the liability. Unearned rent income is 54,000. We convert it as income. Rent income is 54,000. Again, so in the ledger account balances at year end, you will see rent income is 54,000 and unearned rent income is 27,000. So the same under income statement approach and balance sheet approach. Okay, next, so we need also to include these accruals of salaries and interest. So for example, December 31, 2020, there are accrued salaries amounted to 34,000, interest to notes payable of 2,500, and interest from notes receivable 4,500. The adjustments for these particular transactions would be as follows. So for the accrued salaries, salaries expense 34,000 and salaries payable 34,000. The effect of this adjustment will add up to the balances of these particular accounts in their respective ledgers. So the same for the interest payable, we have interest expense of 2,500 and interest payable of 2,500. As simple as that. The same with interest receivable 4,500 and interest income 4,500. It is very important to update or include this adjustment during your year end because your asset, liabilities, or equity may be under or overstated, or you cannot arrive at their correct balances if these are being omitted or not included. Okay, next is depreciation. So for depreciation, for example, depreciation on building for the year amounted to 15,000. So the adjusting entries for this would be depreciation expense, building 15,000, and accumulated depreciation, building. Okay, so I hope guys you followed this simple discussion on adjusting journal entries. So I hope to see you again in our next video tutorial. So before we end this tutorial, may I give to you a simple question. So question of the day, and you can comment the answer on the comment sections below. Okay? So question number 1, true or false? The cash account is found in adjusting entries. Number 2, all adjustments affect both the balance sheet and income statement. The first 5 to comment the correct answer in the comment section of this video will be shouted out in our next upcoming videos. So thank you for watching and good day everyone.